Hey guys, it's Michael and Ewan from Modano, and we are here to go through the historical consolidation modeling training course. This is a follow-on course from the all periods or the consolidation model training course. So we're assuming that you've done that, that you've understood the concepts in that, because we will be basically sliding over a lot of detailed concepts with regards to things such as eliminations, because we spent a good half an hour on those on our last video. So we're going to focus specifically on the historical consolidation modeling type here. Now, if you look at my screen at the moment, the model scope here is identical to what we did last time. So we're using the same entities, Wall Street Promotions and Champagne Towers, being consolidated into Wall Street Events Group. But the big difference here is, unlike the all periods consolidation model we built last time, this is going to be what we call an historical consolidation model. Now, an historical consolidation model is quite different. We're going to discuss how and what you need to think about when building them in this exercise. But in many regards, the concepts are the same, such as aggregation methods, eliminations. There are just slight nuances. So we are going to build an annual 8-year historical and forecast model. Now, every historical and forecast, every historical consolidation model is using an historical and forecast construct for time series. So unlike all periods, which can be historical and forecast or just forecast, these are always rolling models. And the consolidation is of the historical financial statements. So let's just look at the structure we're talking about here. Now, basically an historical consolidation model is a consolidation of the historical entity financial statements into consolidated historical financial statements prior to doing a single forecast for the combined, effectively pro forma entity. Okay, so it's quite different. So if you look at the structure of an all periods consolidation, which we went through in the last training course, you have completely independent entity models, and then you consolidate the entity financial statements into consolidated financial statements and do the eliminations effectively in the all periods consolidated financial statements. Now, that means, for example, in each entity, the tax and the capital structuring is done on an entity-specific level. There is no tax consolidation. There is no treasury consolidation. Now, in an historical consolidation model, you basically take the entity historical financial statements out of something like QuickBooks, Smile, Hyperion, SAP, whatever you're using, and you consolidate those, put through eliminations, and then build effectively a single entity forecast model. So what we're actually doing here is, it's an interesting type of model, because if the entity is a tax consolidated, it will actually give you a very accurate single entity projection, because the forecast will be tax consolidated and treasury consolidated. If they're not, it's really just a really simple way of doing a quick console. So if you really want to see a really quick view of a business brought together, you can do this, but you do need to bear in mind that an historical console is going to do a single tax forecast. So if one entity, for example, had tax losses and one didn't have tax losses and used an historical console, it would forecast them combined, when in reality, if they weren't tax consolidated, one of them wouldn't be paying tax and one would. So the combined entity would probably have a different tax position. We're going to talk about that stuff on the way through. So basically, when looking at different consolidation types, you do need to think about things such as how you are going to forecast tax and treasury consolidation, because if you're tax consolidated, the historical consolidation method will work really well. Okay, so let's dive in and give it a shot. Okay, so let's open up Excel, and just like this exercise is going to be very, very similar to the last one. So we're basically going to start off with a dynamic template, set the time series assumptions, import a whole lot of entity data, and then just talk through, look at the eliminations and just talk through how it all works. Cool. Once again, we have a whole lot of high-powered macros to do all the heavy lifting. Yep, good. So this course will be quite quick. This video will be quite quick. As per the last video, feel free to fast forward, pause, slow it down. Probably. Slow it down. We're going to brush over concepts here. There's a lot of detail in the actual PDF document alongside of this on the website and in the user guide. Yeah. Okay, so let's open the assumptions file. So we've got that open now. Cool. And you can see the transfer assumptions buttons are there. Now just like last time. Just like last time. There's a lot more sheets in this one, because we're going to go through basically the importing of each different area of the forecast separately, just to make sure we understand what's actually going on there. Okay, so you can see the sheets we've got in there are the Wall Street Promotions historical income statement, the Champagne Towers historical income statement, and then we have the historical balance sheets for both those entities. Then we have the consolidated historical income statement and historical balance sheet. Now, in this instance, in this course, we're going to use the reclassification method. Okay. In the last course, we used just the categories. We're going to use reclassification because it's something you're more likely to do, I think, in the historical console, where you've got a whole lot of often really badly structured financial statements coming in out of different like entity accounting packages, and then you're basically putting them into one beautiful forecast.
Okay.
So in this case, you really don't want to be forecasting zero values that have been eliminated. You really want to restructure it. So we're going to use that reclassification aggregation method in this exercise, which is a good example to demonstrate that. Okay, so the first thing we're going to do is just start by opening a new dynamic template. Okay, so just like we did last time, we're going to go to the Modano tab, New menu, and we're going to load the dynamic template dialog. Let's just use Summary View again. And just this time, let's select the historical consolidation model as the starting point. And you'll see again, you've got a whole range. Now, with historical console at this stage, this may change in the future, but we don't have multi-currency. We obviously don't have multi-workbook for this at the moment. But you can do all sorts of funky stuff. So we built a model recently for a client that had multiple entity historical consolidations into full all periods consolidations across multiple workbooks.
Yeah, right.
And some of those entities have multiple business units. So it's kind of like Lego. You can just do whatever you like. But on the whole, as a starting point, just you should really be focusing on using one currency per historical console, because it's quite strange to do consolidations of multiple currency historical financial statements. So what we're going to do is we are going to start with the historical console. Instead of using the categories chart of accounts 1, we are going to do the reclassification chart of accounts 1. So historical consolidation model.
Are we using distributed eliminations?
We are going to, we're not going to do distributed eliminations.
Cool.
We're just going to do reclassification.
Sweet.
Okay, so we're going to choose annual historical forecast, United States, single component, none. So we're exactly the same properties as we used for the last one.
Yep, of course.
So let's do that, and let's open that up. Now, when that opens, it's quite different to what you saw with the All Periods console. So if you remember the All Periods console had one section per entity, and then we had a consolidated financial statement section which did the consolidation.
Yep.
Now, in this instance, we have the entity section which contains all the entity basically data and analysis in one section with subsections, and the subsections aren't by entity. They're actually by historical financial statement. And we've done that because when you scale this up, it doesn't add new subsection covers, it just adds new historical financials for each entity, which we're going to do towards the end of this exercise. So you see it still has an entity summary module, which is where the entity name data and the notes are entered. But you look at the structure of this, like in that diagram we looked at earlier, you basically have the historical income statement and the historical balance sheet for each entity being consolidated into the consolidated historical income statement and the consolidated historical balance sheet.
Cool.
So if you click on the consolidated historical income statement, you can see in there that because it's a reclassification, if you open up the revenue there, you can see that's where the categories come in from the different entities.
Yep.
Okay, so at the moment there are 6 categories because we've got the default 3 categories per entity per data type. So let's just go and name this model. Let's go to the overview sheet and let's just name this again Wall Street Events Group. And in this instance, let's put the model name as historical consolidation model.
Cool. Can do.
And just add the first note: historical consolidation model of Wall Street Events Group. This is obviously just best practices, guys. And remove the other 2 notes. And then we're going to jump in and we're going to take a very similar set of steps that we took in the last exercise. So the very first thing we're going to do is just set the time series up.
Cool.
So let's go down to the time series in 4A. And in this case, because we're doing 3 years backwards, the last model started in 2000. So technically this is it's like the last model, but with 3 years of historical data in there.
Okay.
With the console taking place prior to the forecast taking place.
Yep.
So it's quite different in that regard, but the numbers should be quite similar operationally at least. So in this case, we're going to start in December year end 2019. So we're going to have 2019, 20, and 21 historical data. 8 periods, so 3 years of historical, 5 years of forecasts. And then we're going to do denomination will be thousands. The last historical year, 2021. Cool. Now let's just confirm that by going to the historical income statement and make sure we've got 19, 20, and 21. That's fine. Yep. And then let's just go to the forecast revenues and expenses in the model. And we've got 22 to 26, which is what we had for the prior all periods console for the forecast model. Okay, so that's our dynamic template set up with no data in it, with 2 entities starting. Now, just like with the all periods console, we're going to start by actually putting our entity assumptions in, starting with the entity summary module. Okay, so let's go to the entity summary, which in a historical console is located in the entity section close to the start, whereas in the all periods it was in the appendices.
Yep.
And again, exactly the same process. So we're going to put WSP for Wall Street Promotions, and then just put the notes as Wall Street Promotions entity.
Cool.
And Champagne Towers entity. And you'll see as Ewan is changing the names of those entities, those names assumptions in column B, you can see the spinning wheel pop up. What's happening when he's doing that is it is renaming the modules, but instead of renaming all of them, because the only modules you have by entity here are the entity historical financial statements.
Yep.
So it's renaming the entity historical income statement and the historical balance sheet for each entity. So if you go to the table of contents now, you can see that the sheet titles have come through for 2.1, A and B is Wall Street Promotions and Champagne Towers historical income statement. And then for 2.2, A and B, we've got the historical balance sheet, the entity historical balance sheets.
Yep.
Now, if you go to the Build tab and just load the Project Manager, you can see that those historical financial statements have been renamed, so that it's really clear which ones are doing which. So if you click on, say, the financial statements, you can see we have the Consolidated historical income statement balance sheet. And then we have under the Entities module area, which is quite interesting. So for this particular content library set of modules, we've actually put the entity-specific modules in an entities module area because it sort of quarantines it, and that means below the entities module area in there, almost all the modules are exactly the same as what you'd see in a single entity model.
Yeah, same colours and everything.
That's it, same colours. I mean, it's funny because it makes you sort of realise that with a lot of financial modelling, even we were just talking before this call, this session about project finance and deals modelling, you're really just talking layers on top of the same foundation. So in this case, it's really the case. I mean, you've really got a normal integrated three-way model, single entity, with the historical financial statements replaced with consolidated historical financial statements that bring in data from new entity historical financial statements.
Yep.
So if you click on the consolidated income statement, historical income statement, and you click on the links for that, you can see it's bringing in the Wall Street Promotions and the Champagne Towers historical income statement data, and then it's operating exactly as it normally would.
Cool.
So in a normal single entity, you just wouldn't have those precedent modules there.
Yep.
That would be the start, and you import your data straight into the consolidated piece, whereas we're going to import the data straight into the entity historical financials.
So it's just kind of one added step onto a normal historical.
Exactly, it's one step backwards.
Yep.
So it's in that regard, the historical consoles is relatively simple in that you don't have to think about, you don't have a huge number of different. For example, you've got one revenue module forecasting the revenue for the group, whereas with all periods you had revenue modules by entity.
Yes. So
everything was much more of a hodgepodge when you're doing multiple models within one workbook. Okay, so what we're going to do now, if you close that, what we're going to do now is just bring the data in. Now, in this course, we have put in a whole bunch of different macros in again because so much of this is not something that is specific to the console stuff. Okay, so if we go to the Wall Street Promotions historical income statement, just in this model, this is where we'd normally bring the data in using the import assumptions tool.
Yep.
Where you could bring out a QuickBook, Xero, Excel, etc., and you'd map it. So don't think this tool we're using here is going to be available when you're doing this outside this course. But if we go into our assumptions file now, let's just click the Transfer Assumptions tool. And make sure you're on the Wall Street Promotions historical income statement. And this will be a lot quicker. This will be a lot quicker than the other one because when we're importing previously, it was doing a lot more. It was adding a lot more categories. So here, it's quite interesting to think about what this is doing. When it's adding or removing categories from this income statement, it's not flowing through the whole model because we're reclassifying those categories. So the revenue forecasts in this model are, at the moment, 3 categories. And they still are before and after this, even when you added one here, because we're just going to have to allocate them. Now, you'll see that there's an error in the consolidated historical income statement. So if you go to that error check and just follow that through, that's going to be because we haven't allocated anything. So if you open, there's a huge error check under there. If you open that up, it actually checks to see that all the data is reconciled. And at the moment, what we have is all the data coming in from revenues, expenses, from that income statement. None of it's being allocated. So if you scroll up to the top, you can see the data with non-values, with non-zero values. It's saying you have to allocate data to revenue categories, which we'll do in a moment. I think what we do first is we bring in the data from the different entities. So let's bring in the Wall Street Promotions. Let's bring in the Champagne Towers historical income statement.
Cool.
And that means we have all of our entity historical income statement data in there.
Okay.
And this is, the really tricky terminology of all this is you've got to constantly think, okay, I've got entity historical financial statements consolidating into consolidated historical financial statements that are then used as the basis for forecasting into the all periods financial statements, which are group based. So it's pretty.
There's a bit to it.
There's a bit to it.
Yeah.
So you see, we've now imported those. We've still got the error in our historical income statement because we now have even more data coming in.
Yep.
And you'll see it just needs to be mapped.
Mm-hmm.
Now let's import the data for our historical balance sheet for both Wall Street Promotions and Champagne Towers.
Cool.
So go to the Wall Street Promotions historical balance sheet. Just click the transfer assumptions macro.
Mm-hmm. That'll dump all of that in.
That'll dump all of that in again, and we're going to have the same issue obviously because the allocation isn't going to be done.
Okay.
So the historical consolidated balance sheet is going to complain, which it's going to throw up an error. So there it goes. Now we've got two errors, and if you go to the error checks, you go to the error checks, it's now going to say
historical balance sheet,
consolidated balance sheet, and if you open up say debtors, just open up. You see all of them are all over the shop.
Mm-hmm.
You open up say debtors as the first. Yeah, there you go. As a current asset. It's saying you need to allocate these three because we've just brought data in from those.
Cool.
Okay, so let's bring in the Champagne Towers historical balance sheet.
Same old. And then will we just be allocating these within the consolidated historical?
That's exactly it.
Okay.
So we're going to be reclassifying them, right?
Yep.
So exactly. So allocating. So first thing. Oh, no, you're right. Actually, we are going to be allocating them to the reclassified data.
Right.
So if you go now, so you can check there. We've now got all of our entity historical data in, and that's all we have to do.
Yep.
We should normally do, via something like the import assumptions tool. Now, once that's in there, we now need to go to our historical consolidated financial statement. So let's start with this. Let's start with the consolidated historical income statement.
Cool.
So go to that in 3A, and you just see if you go back to the table of contents. Basically, everything we've put that all in a section called Consolidated Financial Model to make it really clear that your entities are up there. Your consolidated is the rest of the model, and that's what that structure was showing. You get your consolidation done really early, and then actually forecast quite normally.
Cool.
So if we go to the Consolidated Historical Income Statement, now here this is where we're doing the reclass. Now we looked at an example of this in the last exercise, but we didn't actually do one. It's pretty simple stuff. You basically determine how you want to reclassify, how you want your revenue reclassified for the group, and then you put those categories in, and then you allocate your entity categories to it.
Okay.
So this is where there is a considerable data entry overhead.
Yes.
If it's your business, you'll know what you want. If it's your client's business, you need to say to them, what do you want to see for each line item? But once you get this up and running, it's the set and forget. Okay, so let's go to the assumptions file and just look at what we need for the consolidated historical income statement. So our revenue categories, we have 4 categories. Remember, they're the 4 categories effectively that contain data post eliminations in the all periods. So what we're doing is we're just removing categories that would have 0 values when we reclassify.
Yeah, right.
Okay, so we need those 4. So let's go back to the financial model, and let's just add a category. So right click and add category there. And then we can go back to the assumptions file and let's just paste in those first values. Don't hit the transfer assumptions button yet. That's just cheating.
Just copy paste.
Yeah, I mean, there's a fine line between being efficient and cheating. Okay, so you see what we've done here. The beautiful thing about this reclass is that you can put lovely names in. So if you look at that now and you go to your product launches and go to your all periods financial statements, so go to your table of contents and go to your financial statements at the end and open up revenue. You see in there, you've got beautiful headings. So you don't, unlike all categories coming through, you don't have WSP hyphen, WSP hyphen, WSP hyphen, CT hyphen. So you have this ability to create beautiful financial statements that just look like there's been no consolidation at all.
Yep.
So that's one of the benefits. I mean, we built a model recently of our business that had historical console, and we have like horrible charts of accounts. We just haven't cleaned up our 0 at all. So we just cleaned it up. So our forecast, our centralized forecast, is just a beautiful thing like this. It's just got like, services, software, support, etc. So it means you can clean up a real mess of historical data, which is often one of the biggest challenges in modeling is you have really bad quality data coming in. And you want to create a beautiful financial model that's driver-based. So that's another thing with this. You can make this all driver-based. Okay, so let's go back to the historical income statement, consolidated income statement, and let's just allocate these. So you see product launches. It should be pretty straightforward based on this example. Product launches, network events, it's exactly the same process. We don't have to worry about the hyphens and stuff because they're really simple categories. Now, you'll see here, the CT product launch tower, we're going to allocate that to Champagne Tower packages. And you'll see when we put that in, it's going to actually double count. Okay, because so we know from the last exercise that is an intercompany revenue coming through there. And you'll see that as a result, our revenue contains like, what is that? So It contains like that extra. It contains double counting historically of that number. So we've got that 2,000 or 2 million it would be of revenue, when in actual fact only about 1 million of that is external. So they need to be eliminated. And if you go down to the eliminations down below, and you open up, this is the centralized eliminations, and you open this up, you can see that is where, if you go back to your consolidated income statement in the assumptions file, you'll see the eliminations. You go scroll down to the bottom, and you can see the eliminations are identical to those we did in the all periods.
Yep, makes sense.
Yeah, so we're not going to do that from scratch now.
Okay.
Because basically we spent half the last exercise going through
Correct.
that.
Yes.
But it's the exact same process. So what we're going to do is we're just going to click transfer assumptions.
Okay.
And what that button is going to do is it's going to just import. It's going to set the number of categories based on what's in that data, insert the headings for the reclassifications, and then insert the allocations. And if it works properly, it should actually reduce the number of errors from 2 errors to 1 error, because the income statement will stop complaining because everything will be allocated. And there it goes. So now we've got an error in the historical balance sheet because that still hasn't been reclassified and it hasn't been allocated.
Yep. So
you've still got the end data requiring reallocation, but everything else has been done. And if you look at the formulas in this, which you should spend some time doing, you should probably pause us and spend some time doing that.
Yep.
That's exactly the same as the formulas that were entered in the all periods console exercise, but the difference here is we're linking them, instead of linking them to the entity financial statements for each of the sections in the all periods, we're just linking those to the entity historical income statement and entity historical balance sheet, which we'll do down below, when eliminating those items.
Yeah, of course.
So it's very, very similar. So you look at that one, that top one, for example, which is the negative, what is that, 557?
Yes.
So you look at that 557. If you go up to the revenue, which you had to make, and you find that 557, you see how that is EHIS2, which is Entity Historical Income Statement 2. J16, and you go down below, the formula equals negative that. Exactly what we did last time.
Same process, yep.
So the interesting thing with this, we should also note, is that we haven't bothered to rename the sheet names on this, which you could do. It's sort of up to you. I don't know if in the exercise we actually do that. Let me just have a look. In the assumptions.
But if we did, it would be the same process as what we did in the last one, using the rename multiple.
Exactly.
Cool.
Exactly. Yeah. So I don't think we bother. The reason why I personally don't bother doing the income statement, doing the renaming of those sheets from the EHIS and the EHS to HS2, historical income statement 2, is because when you add another entity, which we'll do at the end, it'll automatically go in numbered and it will be perfectly clear. Yeah. So I mean, we do have a lot of clients that like to see those names. So you could make that, for example, WSP, HIS, WSP, HBS. It's sort of up to you as to whether you do that or not. And if that is in the exercise, apologies if we missed it. So that's our consolidated historical income statement. Let's now do the consolidated historical balance sheet.
Cool.
So just go back. In this case, we're just going to click the button because it is exactly the same process. Okay. Obviously, other than revenues, expenses, you've got assets, liabilities, and equity.
Yep.
But it's the same process. So let's transfer those assumptions. Something worth noting is in a historical consolidation model, you don't have the issue with the opening balance sheet because we don't have an opening balance sheet. So the eliminations are actually a bit easier to enter. So if you see when these go in, this will remove our errors in this model because it's going to have everything allocated and reconciled. And then the eliminations will go in with the formulas, and you'll see that the formulas don't start in column I for the eliminations because we don't have that opening balance sheet.
Yep.
So wait for this to complete. This is taking a bit longer because the categories, when you add and remove categories, for example, of debtors and creditors and debt, it's flowing throughout the whole model. So if you go down now to the eliminations, you'll see the eliminations are exactly the same as what they were in the consolidation model, the all periods consolidation model exercise.
Yep.
But they're just linking to the equivalent periods.
So we don't have that opening.
Exactly.
In column I.
The other thing is we don't the historical cash flow statement in the historical component of the cash flow statements in an historical forecast model is derived.
Yes.
So basically it's derived from the numbers in the actual historical income statement and balance sheet. So because of that, we don't need to allocate the cash impacts because we derive it.
Yes.
And that's different from when we actually forecast the cash flow statement in a forecast model where you allocate the specific cash flow line items. So the process of entering eliminations is a bit simple in an historical console because all you really care about is eliminating specific line items but not allocating them to the cash flow statement. Okay, so that is your consolidated, that is your historical consolidated data, and that consolidated historical income statement and consolidated historical balance sheet is basically now a set of financial statements that you can forecast on as though all one entity.
Yes, right.
And that's what I'm saying when I'm talking about, you do have to think about what's going on here, because obviously that's going to have, for example, one corporate tax payable amount in there.
Mm-hmm.
So it's going to assume when it forecasts that. And if you had a more complex model with DTAs and DTLs, it's going to look at those and assume that they're able to be used by the whole group.
Mm-hmm.
So if you're not tax consolidated, that might not be realistic.
Yep.
So you do need to be aware of what's happening when you're doing these types of consoles. But in many cases, this is actually really accurate.
Mm-hmm.
It's just horses for courses.
So would that, in the context of the tax consolidation, would that be going back to your 40-40-20, spending that time scoping that out at the start of the model, be able to understand whether you're going down the right path or not?
Yeah. So I mean, it's funny. We did a consolidation recently for a client in the US that was not tax consolidated,
mm-hmm.
but all of their entities were profitable for tax
mm-hmm.
purposes. So effectively, there's the summation of all their profits. With a tax rate that was large, with an average tax rate applied across all their entities,
yep.
was an easy way of building them a consolidation model.
Yeah, right.
Rather, because they didn't want an enormous model. They
mm-hmm.
were like, listen, we've got like 6 entities. We'll bring these in. We want to forecast. It was also a multi-business unit model. So the main point of that model is they wanted to see all the different multi-business unit peer analysis,
mm-hmm.
but they had like 6 entities. So it was kind of like, okay, well, they were like, we don't want to build, 6 full entity models. What
mm-hmm.
we want to do is get all the historical data in, clean it up,
mm-hmm.
like we've done here, and then forecast multi-business units out of that data.
Right.
And that was a really powerful model. But it's funny because we effectively did a tax consolidation as a result of this structure, but it was still really accurate because all of their companies were paying tax.
Yep.
So we just had to make an assumption about what the average corporate tax rate was across those different vehicles.
Okay, cool.
Those different entities. So it still works. So
awesome. And
that's where this gets interesting now. So if we look at the forecast, so if you go to the revenue expense forecasts, these are the revenues and expenses of the group, which is why, because we've reclassified them, there are just 4 revenue categories. If you use categories aggregation methods, if you use the categories aggregation method for the historical consoles,
mm-hmm.
and you had like 10 categories and 5 of them were eliminated to 0, you just forecast zeros, which would be really strange.
Yep.
So the reclass is really handy for historical consoles because you just end up categorizing data, reclassifying data in terms of how you forecast the drivers.
Yep. So it's a lot cleaner, I'm guessing.
Exactly.
Yep.
It's a lot cleaner. So once you've got the historical console done and you've got the eliminations in, you're sort of back to where you'd be in the annual forecast model learning exercise.
Yeah, of course.
Where you've just got a normal financial model, but you do need to think about what you're doing when you're doing that. So let's go to the assumptions file and just import the revenues and expenses.
Transfer those
across. And this will be quite quick too because the number of categories of everything was determined. For example, the number of categories of revenue was determined by the historical consolidated income statement. So it's just banging the data in, which you could obviously do manually. So there you go, revenues, expenses, capital expenditure. Again, everything. It's funny, the capital expenditure we've got down there, we've got, because that capital expenditure doesn't come from, we don't have an historical cash flow statement.
Yes.
The capital expenditure is still entity-based there.
Yeah, right.
So you can see we'll allocate that in a minute to fixed asset categories.
Mm-hmm.
So let's do the working capital. Put the working capital in. Again, don't forget the working capital doesn't need to include the debtors and creditors. The intercompany debtors and creditors.
Yep.
So the working capital here just contains, is it just those 3 categories?
We'll see when I can scroll down after this is dropped in.
So there you go. So I think there's just those 3 categories.
Just those 3.
So you remember in the all periods console, and it's funny if you go back to the Wall Street Promotions historical balance sheet.
Yes.
Go to the entity Wall Street Promotions historical balance sheet.
Balance sheet. Sorry.
Balance sheet. Yeah, you can see if you look at that, you will have in there, I think, a creditor. And then have a look at creditors. Champagne Towers creditor, and you've also got the loan to Champagne Towers. Mm-hmm. Neither of those are going to appear in the forecast.
Yep.
So they're basically, if you go and look now at the creditors in the consolidated historical income balance sheet, you'll see that we just haven't bothered putting anything in there. So if you look at the creditors there, go down and open up the creditors.
Creditors here.
Creditors here. You'll see that we're bringing in trade creditors for CT trade creditors there. We're allocating those to trade creditors, but then down below, if you go down to the eliminations, that will also be being eliminated as part of the debtors and creditors. Okay, so and you'll see that movement's being eliminated. So the important thing to note is that once you've got past that console, that historical console, you don't need to think about the console anymore above and beyond thinking about the fact that the eliminations are all done. Mm-hmm. So your consolidated historical financial statement should be ready to sort of set and forget from now.
Yeah, of course.
Okay, so so if you're forecasting an intercompany, you've done something wrong with your reclassification.
Yeah.
Okay, so let's go to the assets.
Cool.
Go to the assets and let's go and import those guys. With the assets, you can see we've got assets. It's interesting. The capital expenditure categories are grouped by entity because we got that data straight out of the entity data.
Yep.
But we're allocating that to four different asset classes that don't reflect where they're from, which is what you'd expect on a group level.
Yep.
So you'll see here, once this has come through, the allocation, we're allocating the WSP, the office fit out. You'll see, for example, the champagne, the office furniture, for example, from CT and WSP is both being allocated to one category. So effectively, that's a consolidation of the office furniture forecast into one class. We're just treating it as one class, which is what you do in this type of model.
Yeah, of course.
Okay, let's do capital. And this is okay. So the capital is an interesting one. So remember, we had that intercompany loan.
Yes.
That intercompany loan we've eliminated in the historical consolidated balance sheet, so it doesn't exist anymore. So ignoring that intercompany loan, we really only need two different debt facilities, and that is the bank debt and the working capital facility.
Yeah, right.
We don't have that intercompany loan, which was reported as a debt facility on the Champagne Towers balance sheet. Okay, so we can transfer assumptions here. Another thing to bear in mind is the equity here is the combined equity of the two businesses.
Yeah, right.
So that's if you've got. That's how we've modelled this at the moment. We've just added up the equity, which is, to be honest, in most cases going to be fine. If you're just doing a pro forma consolidation, that's fine. But bear in mind, if you do have, for example, cross holdings and stuff, you may actually want to eliminate the equity as well, because the equity that's coming in here, the equity value will at the moment be the summation. We haven't done the eliminations of that.
Yep.
But I mean, there are three types of elimination, really common types, and that is intercompany revenue, intercompany loans, and intercompany shareholdings, and we haven't covered company shareholdings in these courses, but that's where you would have to do eliminations for those. So again, the debt and the equity, the capital structuring on this is quite a simple chart of accounts, is done on a group level, which in this example is just the summation of those, which we can check. So if you scroll down to equity, you see we've got the 500 there. So what's our opening balance? If you go to our balance sheets, what's our opening equity for Wall Street Promotions?
For Wall Street Promotions, over here, for equity.
For 450 up there?
Yep.
450 of ordinary equity. And let's go to Champagne Tower. Oh, sorry, the close one is 400, sorry, in the final period.
Yep.
400, and what's this one? Scroll down to 100, so that's the 500.
Cool.
So you have to bear in mind that you're not just looking at that doesn't really exist. So you're looking at 500 equity, which is actually two different shares pooled.
Right.
And that's what you need to be thinking about. But that doesn't really matter in a lot of cases. You've got to think consolidations are not merger models, like we said. They're pro forma models to give a group view. So, for example, the model we build of our business with multiple entities shows us, great, I can see group revenue, group profitability. I can see EBITDA contributions based on different parts of our business, services, software support, etc. I'm not sitting there obsessing over the capital structuring piece. If I wanted to, you would have to either do eliminations or potentially do a more complex consolidation. Or if you're looking at consolidating, you would actually have to do a proper merger model.
Yep.
But that's not what this is. Okay, and most people that are shareholders in multiple entities, that's not their focus. Their focal point is a group view.
Yep.
Okay, so what have we got left? Have we got one more thing? So have we got corporate taxation?
Yep.
Corporate taxation is another one. Okay, so this is another example where if you had to, so let's import corporate taxation. The corporate taxation is another one where, in the real world, particularly if you're in, say, the US, for example, and there are different taxes depending on what suburb you live in. You basically could be in a position where one entity could have a certain tax rate and another could have another, particularly if you're doing stuff like sales taxes. You might even have, if you're in New York, like a tax for just being able to walk in Central Park or have a drink. There's a tax for that. So every time I've been there, I get taxed. It's incredible. You don't even know what you're paying for. But so in that situation, your tax rate has to reflect effectively a profitability weighted average tax rate. But in Australia, where everything's relatively simple with tax, and you've got 4 or 5 entities, they're generally going to have the same rate, so you can just put that rate in. But you need to bear in mind that this is a tax consolidation. That net profit before tax figure is your group net profit before tax. Okay, now it's obviously post-eliminations, but obviously as we discussed in the all periods console, the eliminations don't change your profitability in most cases. They just decrease your revenues to prevent double counting and decrease your expenses. Your profit stays the same. So technically, in most cases, if the entities have similar tax treatments, this is going to be quite accurate as well. But if they're very different tax treatments, or they're not tax consolidated, you need to bear that in mind. When someone says to you, "Oh, wow, we're forecasting paying this tax," you're like, "Well, not necessarily."
Yes.
And that's like a non-tax consolidated. A great example is non-tax consolidated entities. You could have one with a huge tax loss, one without. When you combine them, you have to. if they're not tax consolidated, this is going to forecast as though they are.
Mm-hmm.
So if you put the tax loss in there, you're assuming it's shared by the other entity, which is not realistic.
Mm-hmm.
So they're just little things you need to think about. But as again, in a lot of simpler cases with entities in the same jurisdiction with similar shareholders or the same shareholders, this is fine. It'll give you a good outcome. Okay, so let's just put the remaining items in, which I think is the other financial statement items.
Last sheet,
other. And then there's interest on cash. Another one, interest on cash. This is why this is stuff so interesting. Your interest on cash, you sort of the rate you're putting in there is your interest on. It's your average interest on cash you're earning across the two entities. So if one entity had a huge amount of interest and was earning a high rate, and another one had of cash and was earning a high rate, and one had no cash or negative cash and was getting a huge penalty rate because it was effectively an overdraft, you have to make sure that your interest rate is the weighted average reflection of that in this.
Yeah, right.
But again, if all your entities have, a somewhat like a normal amount of cash in them, and they're in this day and age, they're probably getting 0 or 0.1%.
Yeah, correct.
It doesn't really matter.
Yep.
So it all comes down to materiality, right? So the message with a lot of this is the purpose of this model isn't necessarily to obsessively. If you wanted to do a merger model and look at this sort of stuff, you would. The capital structuring and tax side of this is more pro forma based. It's indicative. It's not designed to be perfect unless you're tax consolidated. But even then, you need to think about what assumptions you put in for your interest on cash.
Yep.
Okay, so that actually completes the model itself. And I think, the big thing to note with this is, we started off by bringing in our historical data, which we normally use the import assumptions tool for, into our historical financial statements. We then did the full consolidation before we considered our forecasts at all, and our eliminations, and that gave us a set of historical financials that we then use as the basis for doing effectively a single entity group forecast. And if you go to our financial statements, you then come and you have all periods financials, and they're a beautiful thing. I'm not sure that probably reconciles. It should reconcile to our forecast only model, the 712.7.
Yep. Rings a bell.
Rings a bell. So that's basically the same model as we did on the all periods console, but for the fact that we've done the historical console before the forecast, and there are all these nuances we talked about.
Correct.
Okay,
and it looks like a much more compact set of financials compared to the other exercise.
And it's important to bear in mind though that a lot of people get confused about the fact that they think if you want to do a rolling model, you need to do a historical console. But the reality is you could still have this structure for an all periods console.
Yes.
But what you'd end up having is separate historical income statement and balance sheets for each entity that weren't consolidated, because the consolidation would then take place from the entity financials, the all periods financials for each entity into the all periods consolidated financials. Whereas what we've consolidated here is the historical financials into the historical income statement and balance sheet consolidated basis. And then these all periods financials are just reflecting everything in there is consolidated by the time it gets to this, even the historical data. And that's the big difference with this type of model. Okay, so one thing we just wanted to touch on in this, because again, it's always a matter of how you want to customize this stuff, is just how you actually customize these models. Now, unlike the all periods consolidation, to add entities to these models, we don't have a specific tool which says add entities, because the way we've built these, we've used what are called modules as categories. And modules as categories are a really smart way of making a module. If a module that contains just totals data, like for example, or just contains a whole bunch of data, but links in like one item, like the historical income statement. So if you go to the historical entity income statement for, say, Wall Street Promotions, that if you open up that row 14 there, under there, that links in the name from the entity summary. Now that's a total only link in, and if you double click on that, that links into a category in the entity summary. Now that structure, combined with specifying to that historical income statement module that we want it to be a module as a category, will mean when we add a category to this module, it's going to say, hey, I'm adding categories, I'm linking out to a module that's been specified to act as a category.
Yep.
And we can actually show that for advanced users. Yep. Just go to the build tab. Build tab and go project manager. Go to the Wall Street Promotions historical income statement, and then go properties. You'll see down the bottom, module as category there, duplicate. And if you click edit, you can see where you set that right down the bottom. There, duplicate. By default, that's none. But by leaving that as duplicate, what that means, and we've done that with the historical balance sheet, entity balance sheets as well. Yep. So if you cancel out of that now, what it means is to add an entity to this, you just need to add a category to that category block. Okay. And it will push another entity in and duplicate the Champagne Towers one. So if you add a category there, you'll see here down below it will say duplicating modules for added categories. Yep. So it's going to duplicate the Champagne Towers historical income statement and the Champagne Towers historical balance sheet.
Right.
And when they duplicate, they are then going to feed into the historical consolidated financial statements. So the consolidated historical income statement and balance sheet. So it's reasonably quick because, again, it's not adding any categories to the forecast because they're reclassified.
So it's just 2 modules.
Just 2 modules. Yep. That's it. So you'll see now if you rename that, which will trigger the renaming of those.
And so we're calling that SPAC again?
SPAC, let's do the special. So we're going to do the special Ponzi acquisition company. Kanye. I love that gag.
Having too much fun.
Too much fun. Okay, so we're going to put the SPAC vehicle in, so special Ponzi acquisition company entity. And now if you just go to the table of contents, you can see that it's scaled automatically. So you can see the sheets along the bottom. We now have EHIS, EHIS2, and EHIS3 for the three historical entities. Excuse me. And we have the same for the historical balance sheets. And you can see it's added those 2 sheets because we've specified for those modules to locate themselves on their own sheets.
Yep.
And that's why it's scalable without us needing a specific tool to do it. Okay, so we now go to our consolidated historical income statement.
Cool.
And you see they're in there now, the SPAC entities. And you'll see, because just like with the all periods, when we duplicated the entire Champagne Towers entity, here we've duplicated the Champagne Towers historical income statement and balance sheet, the entity income statement and balance sheet for that entity. You can see it's just duplicated those categories. So now if you went and imported data and mapped it into your SPAC category, that would then, well, the moment data came in, this will complain and you'd have to allocate all that data.
Yep.
It's not complaining right now because there are no numbers there. So that's the way
So
that...
if I were to throw in $100 here,
Exactly.
this would then trigger that error. Okay.
Exactly. And if you go to the historical balance, you go to the historical consolidation, historical consolidated income statement. There it is. There.
So that needs to be
allocated.
Yeah. Okay.
So, and we've done that because obviously we didn't want to complain just when you start putting data in. We don't want to complain unless you start actually putting data in, because otherwise you'd open up the model and it would say nothing's allocated, and the whole thing would be errors.
Yep.
So it's not an error until there's a value in there. So that's it. So I think in terms of this, and then obviously the interesting thing with this model compared to the all periods console is you can just insert modules the way you normally would. You don't have to worry about those options we had for the all periods.
Yeah, right.
Because there's only one revenue. There's only one. So you're not going to manually put in entity financial statements. You're going to do that using the categories. It's going to be done for you. The entity summary is what it is. So all the customizations you're going to do are going to be in that consolidated financial model, subject to you changing the chart of accounts in the entity financials. And therefore, it's pretty normal. Like if you put in another revenue module now, it would easily, you can put one in. So just insert another revenue module, and you'll see what will happen here. It's quite interesting, actually. If you put in another revenue module, just put in, say, an amount and growth rates one.
Amount and growth rates, did you say?
Yeah, put amount and growth rates. That's growth rate. Oh, sorry, it's because it's historical and forecast. The growth rates is fine. Let's do growth rates because that'll grow off the historical data. So this is interesting. So when you put this in, what this is going to do is it knows where to go because there's only one set of revenue expenses.
One section to go to.
So it's going to put that in after the existing revenue module. It's going to, by default, have 3 categories, which means it's going to add 3 categories to the historical. So you see here, it's going to add categories 5, 6, and 7. So if you go back, double-click on that, it's going to add 3 categories to the reclassification.
Yep.
So you can now put A, B, and C on those. That always happens to me. So that always happens to me. So put A, B, and C on those, and now if you do the drop downs with the allocations of the SPAC, you can now allocate to those. But the interesting thing about that was you're able to module in. It went in exactly the right spot. It filled through because we've got reclass. It automatically added new categories historically and asked you to allocate to them. And then basically you're ready to go.
Yep.
So you don't need to worry about those options and the linking because there's not multiple entities to link to unless you're looking at the historical entity financial statements, which are completely handled by the adding of categories and the modules as categories.
Yep. So when I basically inserted this now, this handled that in the same way that if it was just a normal historical forecast model.
Exactly.
The exact same way.
Exactly the same way. So it's funny, a normal historical and forecast model, if you go back to the historical income statement, a normal historical and forecast model here just simply wouldn't have that entity allocation. Those rows wouldn't be there, and the rows above would be assumption cells.
Yep.
And you wouldn't have that data linking out saying what's mapped. You wouldn't need because that data in column I is used for mapping purposes. It's used for alignment purposes. So if you click on J14 and press F2, you see that's how it maps. And that's where the sum if slow everything down. But if you don't have too many of them. You sort of Excel gives you a lot of leeway, but a lot of people just go crazy with those things.
Yeah.
But that's what it's there for. So that's really how we've created those historical entity income statements. Is we've just taken the default one, removed the assumptions, brought in the links in from the entity historical financial statements, and then added mapping assumptions and calculations.
Cool.
And the links out are exactly the same. So that's it. So that's an historical consolidation model. It's, as you can see, it's a bit easier than the all periods, but at the same time, you have to understand the implications of what you're doing, like the tax consolidation, the financing, and the reclassification is probably something you're going to want to consider using when you're doing an historical consolidation model. But it's very powerful, particularly when you have a whole bunch of different entities and you just want to very quickly get a consolidated view of them without having an enormous model. So hope this has been helpful. Until the next time.